All right, listeners, welcome back for another deep dive with yours truly.
And me, of course.
Of course. I couldn't do it without you.
Well, someone has to keep you on track.
That's true. That's true.
And provide the deep insights.
Well, I think we make a pretty good team.
Indeed, indeed.
So in our last deep dive, we were talking about the backing of currencies.
Yes.
Specifically gold.
Real tangible assets.
Right. And so today we're going to kind of continue that thought.
Yes.
But dive specifically into how the modern financial world handles your everyday money.
The system that underpins most of the global economy.
Yeah. And it's pretty fascinating.
Yeah.
And honestly, a little bit
surprising for many.
Surprising. A little bit scary, even,
Yeah.
I would say.
Potentially, yes.
Especially for someone like me, coming from the world of poker, this concept of fractional reserve banking always felt a little bit like, a gamble.
I can see why you'd say that.
Yeah. You're essentially betting more chips than you actually have right there in front of you.
It is a system built on a degree of faith and trust.
Right. And if someone calls your bluff and you can't cover the bet well,
the consequences can be quite severe.
Yeah, you're in trouble, big trouble.
And that analogy actually highlights the inherent risk within the fractional reserve system.
Okay, so let's break this down for our listeners. When you deposit your money into a bank, let's say it's $1,000.
A nice round number.
Yeah. Where does that money actually go? I mean, it's not just sitting in a vault somewhere, is it?
Not all of it, no.
Okay, so what's actually happening to my $1,000 when I deposit it?
So when you deposit that $1,000, the bank isn't required to keep the full amount on hand.
They don't.
No, they only need to keep a fraction of it available as reserves. Hence the term fractional reserve banking.
Okay, so how much are they actually keeping then?
The exact percentage varies depending on the regulatory requirements in each country or jurisdiction.
Okay.
But it's typically a relatively small portion. Let's say, for example, 10%.
10%. So in our example of $1,000, that means they're only keeping $100.
Precisely. And what do you think happens to the remaining $900?
Well, I'm guessing they don't just let it sit there doing nothing.
You guessed right. They lend it out.
So they lend out my money.
In a sense, yes. That $900 is then used to provide loans to other individuals or businesses.
Okay, but then what happens to that money? I mean, does the person who gets the loan just stuff it under their mattress?
Not usually.
It goes back into the system.
Exactly. They're likely to deposit it into their own bank account, and then that bank can lend out a portion of that deposit and so on.
So it's like a chain reaction.
This is what's known as the money multiplier effect.
Money multiplier, that sounds kind of powerful.
It is. It means that your initial deposit of $1,000 can actually lead to the creation of multiple times that amount in new credit throughout the economy.
So my $1,000 could potentially become $10,000 in loans?
Theoretically, yes. If the reserve requirement is 10% and the money keeps circulating through loans and deposits, that initial deposit could multiply up to 10 times.
Wow, that's pretty wild.
It does highlight both the potential benefits and the inherent risks of this system.
Okay, so let's talk about the risks, because this whole thing is starting to sound a little bit, shaky to me.
The primary risk lies in the fact that banks are only holding a fraction of their deposits in reserve.
So if everyone suddenly wants their money back, they're screwed.
Well, that's a bit of an oversimplification, but essentially, yes. If a large number of depositors simultaneously decide to withdraw their funds, the bank might not have enough liquid assets to meet those demands.
And that's what we call a bank run.
Exactly. And historically, bank runs have often led to the collapse of financial institutions and even broader economic crises.
Like in 2008.
The 2008 financial crisis was a prime example of the systemic vulnerabilities that can arise within a fractional reserve system.
I remember that it was a pretty scary time. A lot of uncertainty.
Indeed, it highlighted the importance of confidence in the financial system.
Because if people lose confidence,
then they're more likely to rush to withdraw their funds, which can create a self-fulfilling prophecy leading to actual bank failures.
So essentially the system is built on trust.
To a large extent, yes. Trust that the banks are managing their reserves responsibly, and trust that depositors won't all panic and demand their money at the same time.
Okay, so we've talked about this fractional reserve system, which sounds a little bit like playing with fire.
It does have its inherent risks.
But you mentioned earlier that there are alternative models, emerging ones, that are built on a different foundation.
Yes, and one of those models is based on the concept of over-collateralization.
Over-collateralization. Okay, so what exactly does that mean?
In simple terms, it means that the value of the assets backing a particular financial instrument is greater than the value of the instrument itself.
So it's like having more chips in reserve than you're actually betting.
Exactly. A good poker player always keeps some chips back.
All right, so in this case, instead of having just a fraction of deposits in reserve, they have more than 100% backing.
That's the idea. It creates a much larger margin of safety.
So even if the value of the underlying assets fluctuates,
there's still a buffer to absorb those losses and protect the value of the instrument.
Okay, that makes sense. So is there like a real-world example of this over-collateralization thing in action?
Absolutely. A prominent example in the cryptocurrency space is the Oracle Free Dollar, or OFD protocol.
OFD, okay, I've heard that name thrown around. Tell me more.
OFD operates on the Binance Smart Chain, or BSC.
BSC, got it.
And it's actually a successful fork of an earlier project called Frankencoin, which ran on the Ethereum blockchain.
Okay, so how does OFD actually use over-collateralization?
Well, with OFD, users have to deposit cryptocurrency assets as collateral.
Like Bitcoin or Ethereum?
Exactly, or other approved cryptocurrencies.
Okay.
And the crucial part is that the value of this deposited collateral has to always be greater than the value of the OFD stablecoins that the user can then create.
Stablecoins. So these are like digital tokens that are pegged to the value of the US dollar.
Precisely so. For every OFD stablecoin in circulation, there's more than $1 worth of cryptocurrency backing it.
So it's like a safety net built right into the system.
Exactly. It's designed to ensure that even if the market experiences volatility, the OFD stablecoins remain stable and redeemable.
And that's not all OFD is trying to do, right?
Yeah.
I mean, they have some pretty big ambitions.
That's true. They're aiming to create a more accessible and transparent, decentralized financial ecosystem.
Decentralized financial ecosystem. What does that even mean?
Well, essentially it means moving away from traditional financial institutions and creating a system where individuals can lend and borrow directly from each other.
Peer-to-peer finance.
Exactly. And OFD is designed to facilitate this by enabling Oracle-free lending and borrowing.
Oracle-free? What's an Oracle in this context?
Think of an Oracle as a data feed that provides information to the blockchain.
Okay.
So traditional lending platforms often rely on oracles to get price information for different assets.
To determine interest rates and collateral requirements.
Precisely. But oracles can be centralized and potentially vulnerable to manipulation.
So OFD is trying to cut out the middleman.
In a sense, yes. Their oracle-free design aims to create a more decentralized and secure system.
Okay, so this OFD thing, it sounds pretty revolutionary.
It's certainly an innovative approach, and it's gaining a lot of traction.
But what I find most interesting is this emphasis on transparency.
Yes,
Yeah.
with OFD, because everything is recorded on a public blockchain. Anyone can see exactly how much collateral is backing the stablecoins.
So you don't have to just trust that the system is working as intended.
Exactly. You can verify it yourself.
That's a big difference from traditional banking, where a lot of the inner workings are shrouded in secrecy.
Transparency is a core principle in the world of decentralized finance.
And it's something that I think a lot of people are starting to appreciate.
Especially given the events of recent years.
Right? I mean, after 2008, people are understandably wary of opaque financial systems.
Transparency and verifiable backing can help rebuild trust.
Okay, so we've covered a lot of ground here today.
We've explored the mechanics of fractional reserve banking.
Which is the system that underpins most of our traditional financial institutions.
And we've also looked at an alternative model based on over-collateralization.
As exemplified by the Oracle Free Dollar protocol.
Two very different approaches with distinct implications for stability and risk.
So for you, the listener, the key takeaway here is that it's important to understand the underlying mechanisms of the financial systems you're participating in.
Whether it's traditional banking with its fractional reserves or decentralized finance with its emphasis on over-collateralization.
Because knowing how your money is being managed and what risks are involved is crucial for making informed financial decisions.
Absolutely. And it empowers you to take control of your financial future.
And that brings us to the big question, the one we want you to ponder as you go about your day.
The million-dollar question, if you will.
In a world that's becoming increasingly volatile and unpredictable, which model offers a more secure foundation for your financial well-being?
A system built on fractional reserves and trust, or one that prioritizes verifiable backing and transparency.
It's something to think about.
Food for thought, indeed.
And speaking of food for thought, on our next deep dive, we're going to be exploring a pivotal moment in global financial history.
The dismantling of the Bretton Woods system.
That's right. We're going to delve into what happened when the world decided to sever the link between the U.S. dollar and gold.
A decision that had far-reaching consequences.
And continues to shape the financial landscape we navigate today.
So make sure you join us for that deep dive.
It's going to be a fascinating one.
Until then, keep those thinking caps on.
And we'll see you next time for another illuminating deep dive.
Goodbye for now.
So long, everybody.